But one thing that is fairly clear is bond yields have been on a downward trend. People are going away from risk assets like equities and they're going into maybe safer assets like bonds. And then the other thing with it, of course, is people probably pricing in rate cuts, right? So, okay, with these tariffs, who knows what's going on specifically, but looks like more likely than not over the next couple of years, we'll have more rate cuts than maybe we anticipated at the beginning of the year. So kind of taking what's the tech spin on this, it's the one that I think I've honestly been preaching on this podcast for a while, which is, if you're uncertain as a mortgage broker and you're living and breathing this stuff all day, every day, your clients are extremely uncertain, right? They have no idea what these types of things mean for them, what are their options, anything like that. So I think it's just, again, another great opportunity to say, yeah, there's a lot of turbulence out there, but actually this turbulence can be a good news story. Hey everyone, Tom Hall here from Mortgage Tech Talks. Coming to you again this week with another episode. This one is another industry update. We haven't done it a bit, and there's a lot going on in the industry. Namely, I talked about three big things. One being Rocket Mortgage Canada, big news there, leaving the space. Probably old news by the time this podcast released, but still huge news. We got to talk about it. Number two, talk a little bit about, again, zooming out, Canada-US relations, what it means for bond yield, stuff like that, what it means for your clients, and how you can really craft that messaging. And then finally, Canada Mortgage Awards. They've come out, I think, a couple kind of interesting takeaways, right? I'm actually surprised by some of the people on the list. Not that they don't deserve to be on the list, just I would have maybe expected other names. And so really, what does that mean? I think for the tech and the mortgage industry at large, I think there's some interesting takeaways. So it's a cool episode. We'll see you on the other side. Hello, everyone. Welcome back to another episode of Mortgage Tech Talks. Today, we're doing another market update. A lot going on in the market. So we're going to get right into it here. Starting with, which is honestly, by the time this releases, I'm filming this on March 7th. It already feels like old news by the time it releases, which I think will be next week, March 14th. Pi Day for anyone, 3.14 for all our math nerds out there. This is going to feel like really old news, which is, of course, Rocket Mortgage Canada leaving the country. So for anybody who is not fully up to date with exactly what I'm talking about here, here's a quick article from Canadian Mortgage Trends. Basically just summarizes, I think the story broke from a local Windsor paper, because of course that's where Rocket Mortgage Canada is based, given that their US counterpart is right there in Detroit. Yeah, so that kind of broke there, and then everybody kind of scrambled to pick up the story. But yeah, long story short, I think it was a decision to kind of refocus on the US market, their home base. Of course, it's a bit of a sad story. I know a couple of those guys personally. Of course, we've had even some on this podcast. I don't think it has anything really to do with the team. I don't know. I mean, it's so hard to say from an outside looking in, but from my interactions with the team, they've always been a great team, it seems. But long story short, that's happening. And yeah, it's too bad to see another lender kind of get shut down there. But, it's an interesting thing. A lot of people, I think, are saying, hey, is this a response to the tariffs? My take on it is it probably wasn't just that, right? There's probably 100 different, a lot of these really big decisions, after 5 years of running a business, to shut it down, that's a massive decision. Probably didn't have, I would say, wasn't the only factor, but it probably didn't help, right? Just this uncertainty, this protectionism, this type of ethos probably didn't help the decision. Maybe it was the straw that broke the camel's back. I don't know. But that's kind of my take on that. I don't think you completely attribute to it, but it certainly didn't help, right? I think that's a good way to do it. But bringing it back to the tech side, of course, everyone right away from a tech perspective starts saying, okay, what does this mean for Lendesk, Finmo? Of course, because they are owned by Rocket Mortgage, right? So there's Rocket Mortgage in the States. They, of course, own Rocket Mortgage Canada, but they also own Lendesk and Finmo. And so I'm sure enough of those questions came swirling around. And so in response, actually the Finmo team, and I think was a great move, Finmo/Lendesk team kind of came out, kind of getting in front of the story, so to speak. I think they probably were getting a ton of inbound requests and just said, hey, let's get in front of this. And so I'm sharing on my screen here basically a letter that Joe Tompkins, who's on the team there, he shared on his LinkedIn. And this is a letter from their president, Carter, where he basically just talks through it. He says, the three big themes he talks about is they're still here. Lendesk is still here. Great. and they're profitable and they're growing and hiring in the Canadian market. They're dedicated to that. Second, that they're grateful for the Rocket Mortgage team and what they did. And third, Lendesk is really pushing hard, right? They are trying to change from a technological perspective what it means to do mortgages in Canada. It's a movement and they're still very excited about it, and they invite anybody to come along. So, reading that, I think it's a nice letter. And I think that my take on it, right, when people say, okay, well, Rocket's leaving and sure, Carter could write this letter, but what does it really mean? What does it all mean? Of course they're going to do a letter like this. My take on it is, I've had conversation with Carter. I think most of what he said in this letter, he said to me privately. And so I don't think this is him, putting together a story or anything like that. I think this is absolutely true and how they think and act over at Lendesk/Finmo. So I think my take on it is exactly at face value. I think the letter is genuine, again, based on what I know about the company and about Carter and Joe and all those guys over there. And so I'm not reading too much into it as it relates to really what it means for Lendesk's future. I think, you have to evaluate that company and their operations for what they do, not what their sister company and other people do around them. So that's kind of my take on it. But there's always a but to it. So that's kind of the, hey, give the benefit of the doubt. Unless I see it otherwise, I'm going to continue thinking that Lendesk is doing their thing. The but, though, with all of this, I think is not just a comment on Lendesk and Finmo. I think it's a bigger comment about Canadian and Canadian mortgages, Canadian mortgage tech, even, let's say, is that, there's enough of these factors swirling around, and this is a signal to it to say, I don't think that a lot of US companies are, at least right now, looking up to Canada and saying, hey, that's a market that we really are excited about and want to go address. And some of you listening might say, well, that's a great thing. We don't want the competition. We believe in Canada. We can believe that we can make a difference. And, that could very well be true. I'm not going to argue that one way or the other. But my take on it is more options are always better. More options are better than less options. And specifically in the eyes of the consumer. We've heard endlessly about our telcos being endlessly uncompetitive. We really only have 5 banks in Canada that do 80, 90, whatever it is, % of the mortgages in Canada. And I think ultimately that doesn't serve the consumer. I think the best way to get innovation, we talk about, again, getting things like open banking and things like that. The best way to get it is competitive pressure, right? But if we have, these oligopolies, these very small number of companies that control very large industries and very hard to compete with them, and foreign, I guess you could say, companies wanting to come to Canada but not being able to compete with them directly, it just leaves us with less choice, less competition, which ultimately I think hurts the consumer. So I'm not cheering about this move. Absolutely not. I think it is too bad, but it is what it is. And I think it's now kind of heads down and let's keep building in Canada, so to speak. So yeah, that's one big story and kind of my take on that. Let's jump to story number 2. So story number 2, again, I guess it's a little bit related to story number 1 with, okay, lots happening in the US. What does it mean for Canada? I mean, if we zoom out a million degrees, is that the right one? Let's just zoom out. I don't know if degrees is the right word there, but in any case, if we zoom out, obviously there's a lot of turbulence, right? Tariffs are on, tariffs are off, tariffs. Again, me filming this on the 7th probably means by 14th when this releases, everything I'm about to say is going to be maybe irrelevant, but I'm going to say it now and we can get just in front of it here. But yeah, there's a ton of turbulence, of course. I'm going to make predictions about what the future looks like, what the next week, what the next month, what the next year looks like. You almost have to take it day by day, tweet by tweet almost. But one thing that is fairly clear is bond yields have been on a downward trend. And this has been going on for a few months now. The Canadian 5-year is on a downward trend. Of course, obviously that impacts our fixed rate mortgages there. And I think my take on it is in uncertain times. Well, I think 2 reasons it's going down probably. Uncertain times, people are going away from risk assets like equities and they're going into maybe safer assets like bonds. And so as you buy more bonds, people buy more bonds, rates will go down. That's one thing. And then the other thing with it, of course, is people probably pricing in rate cuts, right? So, okay, with these tariffs, who knows what's going on specifically, but looks like more likely than not over the next couple of years, we'll have more rate cuts than maybe we anticipated at the beginning of the year. So kind of taking what's the tech spin on this, it's the one that I think I've honestly been preaching on this podcast for a while, which is, if you're uncertain as a mortgage broker and you're living and breathing this stuff all day, every day, your clients are extremely uncertain, right? They have no idea what these types of things mean for them. What are their options? Anything like that. So I think it's just, again, another great opportunity to say, yeah, there's a lot of turbulence out there, but actually this turbulence can be a good news story, right? And especially maybe you're at a variable rate and you're feeling, what is the next year going to look like? And I am in this variable thing, which sounds really risky. It's a conversation we had, said, hey, you're in this variable rate. Maybe we get you over in a fix that is on a downward trend. We can watch it. Maybe it'll continue to go down. Who knows? But in any case, it's a conversation to really help your clients. And so, from a tech perspective, I think it's a contact management tool coming in, finding the right filters, finding those people who might be in that riskier situation, and just having a very informed conversation. You can't go really wrong with that. So I think it's just an interesting thing to, of course, pay attention to. So that's story number 2. And then finally, story number 3, we're going to wrap up, is the Canadian Mortgage Awards. So they just released the excellence winners. And I'm going to be, I guess, tooting my own horn a little bit here because we ended up on a couple of those lists. And I think that's exciting. And of course, we're very grateful to the Canadian Mortgage Awards, as well as, of course, the mortgage industry, the folks who nominated us. But let's get into it here. I think there's actually 3 categories from a tech perspective I want to at least highlight. So for starters, let me just share my screen. There we go. For starters, we're going to do Industry Service Provider of the Year. So this is one we've done for a while. And looking at this for people who are at home maybe listening, we got Blue Mortgage, Dolphin, Fundmore, Haven Tree Bank, Mortgage Marketing Coach, Remic, Scarlet, Solidify, Tactical Mortgage Solutions. We just had Russ on last week. And then the Mortgage Nerd training courses. So this is great. But what's really interesting to me, Service Provider of the Year, I only see one of the deal submission platforms, only Scarlet. So that's interesting. So why haven't the other ones gone out and done something like put their name in the ring, right? Is maybe that not so much a focus right now, or maybe they aren't at the caliber of being an industry service provider of the year. I don't think that's what it is, but it's just interesting to see that, hey, these submission platforms aren't really, I guess, being involved with these types of things. I'm not completely sure. But what I think is also really exciting is that even beyond the deal submission platforms, there's actually not a ton. There's more than I've ever seen in any of these other years of non-tech providers, right? I think in previous years used to be all tech, right? But now we have, Haven Tree Bank, and we have the marketing coach, and we have Remic and Solidify, not quite tech, and training courses, right? And so it's kind of interesting maybe just to see where the value in the industry is shifting, right? For a while, 2021 through to maybe 2024, it's tech. You couldn't get away from it. And maybe there's just a little bit of exhaustion. Maybe that's what it is, right? People are a little bit exhausted, all this tech talk, no pun intended with this podcast. But maybe people are a little bit exhausted with it. Or, people just realizing that, hey, tech is not the only place to find value. Tech is not the only place to be a service provider. There are a lot of opportunities elsewhere. And now that, there's not a ton of whatever you would call it, big, checks being written, because there's not, because, well, it's just the state of I would say the tech market right now, where it's very hard to raise money, let's say, then, people are finding ways to provide value elsewhere. And I think it's a good thing. I think it's a healthy thing. I think that if you have just one type of service provider in industry, well, that's not really serving the industry properly. So I think this is a healthy thing and a good thing. The next one I'm going to talk about is basically just, I guess, the digital innovation in a brokerage. I don't think there's too much of a story here. Just to rattle it off, though, we have Six Portal. We know those guys well. 12, Blue Pearl, Citadel, DLCG, which DLCG I thought was, the network, but whatever, where it's brokerage, that's fine. HomeWise, Premier, Qantas, Rate Hub, Syndicate Lending, Tango, and TMG. Again, thought network, but brokerage, and those lines are blurred. So in any case, really solid group there. I don't think there's much of a story. I won't go too much into it there. And then the last one, this is a new category. They're doing it new this year, so I thought I'd highlight it. It's the Innovator Champion of the Year. And then again, just to rattle these off, we have Adrian Schultz from Centum, Chris Grimes from Fundmore. He's been on the podcast. Inem Kirshi, Jared Stanley, Joe Fackery from Scarlet, Ross Taylor, Russ Morrison, talked about him, myself, Tom Hall, Blue Mortgage, and then finally Tristan Kirk from Citadel. But the interesting thing here, again, is I would think, again, going into this, that everyone on that list, when they I put my hat in the ring and said Innovator Champion of the Year, okay, I'd be going against all the other, big tech players out there. But half of these, I counted half of the 10, so 5 of the 10 aren't tech teams, right? It's, folks like Jared Stanley, who I know is just, he's at a lender. which is great. And so, again, I think it's the same theme, which says innovation is not just happening in tech companies. A lot of innovation is happening in lenders, right? Or in brokerages or whatever it might be. There's a couple brokerages here. So innovation is happening elsewhere. And again, maybe that's just, hey, we're kind of getting back to normal. The pendulum is swinging back. I also think that, again, in a lot of conversations I have on this podcast, the brokerage and the lenders, I should say, that model is still a very profitable model. So that allows to fund innovation, right? I think that that's part of it as well. A lot of people start as a broker, they take the money that they've earned as a broker and they use it to invest in technology or innovation, let's say. And maybe that's what we're seeing here, where, the very profitable and I guess you could say cash rich businesses that are able to invest are those lenders and are those brokerages. And then the pure tech plays, well, like I just said, they're not getting the big checks to go out and do that. So again, it's maybe a reversion back to normal where, hey, the people who are actually able to invest are the people who are able to earn money and, invest in themselves, right? So I think that's really my takeaway there is really, I think, a comment on the tech and the investing landscape that exists right now in the Canadian mortgage space. So that about wraps it up. Hope that was a useful episode. Again, we talked a little bit about Rocket Mortgage Canada. We talked a little bit about bond yields, not too much, but a little bit there. And then finally, the Canadian Mortgage Awards and what that I think that speaks to on the broader industry. As always, thanks so much for watching and listening, and we'll see you next week.